What's up everyone, it's Scotty with Money Investing. In this video, we are going to be talking about asset allocation and correlation. So it's going to be a little bit of an educational / analysis type video for you. And I hope you guys enjoy it and find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. And the link to our Discord and Patreon is going to be down below. I do spend a lot of time creating these spreadsheets for you guys along with the presentations. I would really appreciate you dropping a like on this video, and of course make sure that you do check out the Discord and the Patreon link down below. There is a 16% annual discount available till the end of this month, and we'd love to have you on board. We talk about fundamental and technical analysis pretty much all the time, along with stocks and options. And the reason why I'm discussing this in more detail now, because I think there needs to be some emphasis on quote diversification, correlation, understanding how to appropriately allocate assets as you grow, because after the banking crisis, I think there needs to be some level of understanding how assets in general work. And as I'm also personally gravitating a little bit more towards physical assets and hard assets such as gold and real estate, and those are some things that I'm going to be adding in my portfolio as we go on, I think it's important for me to address exactly how asset correlations work and how you can actually implement those strategies in your own lifestyle as well, in your own financial future, and of course understand how these things work. Because I know there's too much focus on equities, there's just too much focus on stocks, and I'm not saying stocks are terrible or anything like that. I'm still very much bullish and still long-term believer in equities, but I think it's important for us to understand these concepts as well. So hope you guys enjoy it, and let's just dive right into it. So first things first, I'm going to talk a little bit about what asset correlation really means, right? And just give you guys a basic understanding on how this works. So when we talk about correlation between two assets, first of all, correlation will always be between two assets, right? You can't just look at one asset and in isolation, but instead it's going to be a correlation between two assets. So how is one asset class performing with respect to another? And the correlation coefficient that we use is always going to be somewhere between -1 and +1, right? So -1 means that it is negatively correlated. 0 means that it is uncorrelated. There's no correlation between them. And +1 means that it is positively correlated. So positive correlation simply means that both asset classes move in the same direction, right? They're positively correlated. So if one of them goes up, the other one also goes up. If one of them goes down, the other one also goes down, and so on and so forth, right? They're positively correlated, meaning that they are moving in the same direction. Now, if the positive correlation coefficient is somewhere between 0 and 1, they are positively correlated, but they're not perfectly positively correlated, right? Perfect positive correlation would be a coefficient of 1, right? That means they're both moving in the same direction with the same magnitude. If the number is 0.5, or if it's 0.4 or 0.7, right, that's a positive correlation, but the magnitude at which they move in the same direction is not the same, okay? Now, negative correlation just works in the opposite direction, right? It's going to be somewhere between 0 and -1. And that simply means if one asset class is moving higher, the other one is going down. If one of them is going down, the other one's going higher, and vice versa, right? We've talked about a perfect negative correlation is bond prices and yields, right? They move in inverse to each other, right? There's a negative correlation right there. That's a great example how one of them goes up, the other one goes down. That's a negative correlation. Now, no correlation or uncorrelated simply means that the coefficient itself is 0, so we're not really moving anywhere, right? Some instances you'll find one asset class goes up, the other one goes down, but then another time you find them both going down, another time you find them both going up, and then you've got, one time that one of them is going up, the other one's going down. So there's not really a pattern as to how they move. They're completely uncorrelated with each other. They can move, regardless of what's going on with the other assets. So they're uncorrelated. There's no correlation to be drawn between those two assets. So that is asset correlation 101. And, there's actually a very, very nice video by Ray Dalio, breaking down the holy grail on diversification and asset correlation. And of course, how you can reduce your risk by diversifying. Because oftentimes, what happens is that we are so very much focused on equities, right? We are very much into stocks, and we are individual stocks and ETFs. And oftentimes we believe that, or we think at least, that we are diversifying, but what we're really doing is that we're increasing our risk without really diversifying. Because first of all, we only own one asset class, which is equities. And then if you look at your holdings, chances are that you actually have, let's say, ETFs, or if you have individual stocks, ETFs that already have those individual stocks, and then you have maybe other ETFs that already have other individual stocks. So you're kind of like overlapping on each other, right? So there's not really any diversification benefit that we're getting, but instead we're just increasing our risk without having any additional benefit of diversification. So it's a very, very good video, and I'm going to actually dive into this more in detail in our future videos. I'm going to be talking about this a lot more. And this right here is the chart that he talks about. We're going to come back to this. First of all, I'm going to go over my spreadsheet that I pretty much created. So what I have over here is 5 asset classes, or pretty much 4 asset classes. The first 2 are going to be your general SPY and QQQ funds, right? Those are equities, right? S&P 500 and the NASDAQ. Then I've got the long duration bond ETF, TLT. I've got gold, and I've got real estate investment trust, in other words, REITs. So I've got 4 asset classes. We've got equities, we've got gold, we've got bonds, and we've got real estate. And in my future videos, again, I'm going to include more. Maybe there's like a private equity fund. I'm going to include Bitcoin. I'm going to include a lot of other things that we can draw conclusions and draw some analysis on and kind of position ourselves better with all that information. But just to get us started, I wanted to really understand what is the correlation between these asset classes, how they perform against each other. I'll show you some charts that I think are going to be very, very insightful for you. So again, I didn't have the information for everything going back as far as 1999, but if you come down, you'll notice that some of them start to pop up. So we have pretty much information going back as far as 2005 on all of these 5 ETFs. So what I did was pretty much create a matrix, right? This is called a correlation matrix, which you can look at and really understand how one asset class is correlated with another. So if you come all the way down, right? So this is going to be that correlation matrix right over here. And what this shows us really is that correlation coefficient between those 2 assets, right? So if you look at SPY versus SPY, right? That's going to be S&P 500 with S&P 500. That's 1, right? Because you are comparing SPY with SPY. So of course you're comparing the same thing with each other. That's why the correlation coefficient is 1. So they're positively correlated, right? Perfect positive correlation between SPY and SPY. If SPY goes up, SPY goes up, right? So, and then if you compare this to QQQs, right? Once we start kind of going across this matrix, if you look at the S&P 500 and you go across and look at the QQQs, now there, the positive correlation is not perfect. It is not 1. It is 0.84. It is actually very close to 1. So that is a positive correlation, meaning that when the S&P 500 goes up, QQQ goes up, right? That's the positive correlation. When SPY goes down, QQQ goes down. We see it every day, right? We see it every single day when markets are down. Most likely all 3 indices are down. SPY and QQQ are also down. But what really is going to be interesting moving forward in the matrix is then we're going to start to understand assets that are negatively correlated and that are completely uncorrelated from the markets, right? That's how you actually diversify in a much broader sense, right? Because you're looking at investment streams, you're looking at potential investment opportunities that are not going to be correlated with what you already own. Because if that thing goes down, your entire portfolio starts to go down, right? The power of diversification really happens when you are owning assets that are not correlated with each other, right? If you're owning negatively correlated assets, those are called hedges, right? So for example, if you trade options, right? What we do is we hedge our position, right? If I'm selling a call, that means if the stock price goes down, I'm losing money on my actual underlying position, but I'm also making money on the call itself. That's a hedge. That's a negative correlation, right? As stock price goes down, I'm making, and my price for the option is going higher because it's becoming more and more out of the money, right? So that's a negative correlation, and that's a hedge. So if you go across this matrix, you'll notice that S&P 500 with respect to TLT, which is a bond ETF, that the correlation is negative 0.19, right? That's a negative correlation, meaning if SPY goes up, chances are, and it's very much, I'm going back as far as 2005, so we're going back almost 20 years, and I'm going to do like much deeper analysis. We're going to go over even further back to understand that correlation, but you may have heard, right, when stocks go up, bonds go down. When bonds go up, stocks go down, right? That's why bond has been a part of that barbell strategy and part of that diversification strategy that a lot of financial advisors use because it's been seen as a potential hedge against stocks, right? And the reason is because of this number right here, because they're negatively correlated. If stocks are going higher, bonds are going down, and that's that negative correlation of 0.19. If you compare SPY with gold, it is very close to 0. It's actually 0.1. So they're fairly uncorrelated, right? If SPY is going up, Gold can either go up or go down, and same thing when SPY is going down, gold can go up or down. So it's really not that correlated. And then finally, you've got a real estate investment trust. I'm using VNQ in this example. Maybe I'm going to be using something else in the future, but you've got a positive correlation of 0.75. So it's actually very close to QQQs. So if SPY is going up, so is a real estate fund. SPY is going down, so is a real estate fund. So they are very positively correlated. Now, again, you can kind of compare these to other places as well. So for example, if I show you TLT bonds with respect to REITs, real estate, extremely uncorrelated, right? We're about as close to zero as it can be, so 0.04. And if you look at something like, gold with QQQ, so gold correlation with the NASDAQ, again, very close to zero. It's 0.07, right? So extremely uncorrelated. But then you have something like, a real estate fund with respect to the NASDAQ. Again, the correlation's pretty high at 0.64. And then if you can look at something like gold with bonds, right, TLT, it's 0.25. So again, closer to zero as bond prices, and gold is somewhat uncorrelated in that sense. Still a little bit more on the positive side, but about as close to zero as we can get. And again, you've got the bond market, very uncorrelated with the equities, which is SPY and QQQs. Now, another way to really visually see this is something like a dot plot chart, which I've also created over here. I've created 6. I can obviously create a lot more, as many combinations as you want. But what this really shows us is, again, one asset class's performance with respect to another. And the bottom line is that if you see a more spherical chart, right, because right now we've got two axes, we've got X and Y, and in the top right quadrant, they're both up, they're both positive. In the bottom left over here, they're both negative. In the bottom, in the top left, we've got one of them green, the other one's red. And in the bottom right, we've got, again, one of them down, the other one's positive, right? So that's the 4 quadrants, right? That's the 4 quadrants in these charts. And what you will see with SPY and TLT, that it's a lot more leaning towards the bottom right to top right of the screen. That's the negative correlation that it actually represents, right? And if you kind of see the fewer times that TLT was actually positive, SPY was negative. By the way, SPY is on the x-axis over here. So when SPY is down, which is going to be some instances over here, for example, TLT was positive because it's on the y-axis, right? So it's actually higher. So again, you can, and because S&P 500 has seen more green days than TLT, that's why you're seeing this kind of scatter plot more towards the bottom right. But a good visual representation of a negative correlation is going to be something that looks a lot like, let me just screenshot and show it to you. It's going to look a lot like this. So it's going to be more like this. This is going to be more elongated, and it's going to be more from the top left to the bottom right. That's going to be that scatter plot, which is going to show you that negative correlation. For a positive correlation, what you're going to see is something like this. It's going to be also elongated, but it's going to be more towards that top right and the bottom left quadrant. And something that you can see for this correlation is, of course, SPY with the NASDAQ, right? You can see this right over here. Very much elongated. Every time SPY is up, QQQ is up. Every time SPY is down, QQQ is down. The reason why you're not really seeing any dots on some of these over here, the only reason why you're not seeing anything over here or anything over here is because there is no negative correlation between SPY and QQQs. They're both positively correlated. That's why you're seeing this elongated, sort of like a spherical chart, which is at the top right and the bottom left of the screen, because they're positively correlated. Now think about it, right? If the correlation, negative correlation works this way, positive correlation works this way, what would no correlation look like? What would completely uncorrelation chart look like? There's 2 ways that you can actually visually see that. Number 1, it's going to look like a circle. It's going to be all over the place, right? It's going to be in every single quadrant, right? All 4 quadrants. And the second way is that it's going to literally just scatter all towards the mean. It's going to be right in the middle. And a couple examples I can show you is, of course, there's going to be an uncorrelated TLT, which is bonds with real estate, so bonds and REITs. If you come over here, this chart, right over here, so REITs with TLT, you can see how they're scattered closer to the middle, right? Because there's not really any correlation happening with these 2 asset classes. So they're very much scattered right in the middle. You've got some dots in the top right. You've got some dots in the bottom right. You've got some dots in the bottom left. You've got some instances in the top left. So it's very much all over the place because of that uncorrelation. If you come over to another pair, which is going to be, let's do, I don't know if I have REIT with gold, real estate with gold. Let's see. right here. So REITs with gold, again, you're going to see a little bit more closer to the mean again, and they're all in every quadrant. It's a little bit more on the elongated side if you can kind of really draw that chart. But again, the correlation is not that great for these two asset classes either, because gold and REIT we're working with about 0.14. A few more examples I've got is again going to be gold versus TLT. Not a lot of correlation there, and you can see the scatteredness. You can see gold versus QQQs completely scattered all over the place in all four quadrants. So if I zoom out a little bit, you can really start to visualize how these correlations really look. This is non-correlated, negatively correlated. You can see a little bit on the top left and the bottom right. And this right here is very much elongated between bottom left and top right, positively correlated. So going back to this chart, right? And these are sort of Ray Dalio's holy grail. I would highly encourage you to watch this video if you haven't already. You can definitely get a lot of benefit out of it. But what he really talks about is that as you start to add more and more assets, right? So number of assets at the very bottom on the x-axis, you start to reduce the level of risk. And the only way that level of risk goes down if assets are not correlated with each other. Okay, so the different colored lines show you the percentage correlation. So for example, if an asset is 60% correlated, right, with the asset, let's say that you already own assets. Let's say that you own stocks, right, to make things simple. Let's say that you own stocks. You add another asset class that is 60% correlated with stocks. You drop your risk level from 10 standard deviation down to, close to 9%. It's going to be 9 point something percent. Again, I don't have the decimals right in front of me, but it's going to be closer to 9 point something percent. You drop your risk by only that much. However, if you actually add an asset class which has absolutely no correlation, zero correlation with stocks, right? Something that you already own, then you drop your risk in half. You pretty much go from 10% down to as close to 5%, depending on the number of assets you add. Of course, if you add 4 or 5 assets, or different investments, then you pretty much cut your risk in half and you increase your reward potential. And that's what this is showing you over here. That's the risk to return to risk ratio. You start off at 0.25, but as you add more and more uncorrelated assets to your portfolio, you're going to drop on this vertical line, and your return to risk ratio actually increases by 5-fold, from 0.25 to as far as 1.25 if you continue to add more and more uncorrelated assets. And that's where the holy grail, according to Ray Dalio, is. Again, I'm going to be doing more detailed analysis on a lot of the asset classes. I just wanted to scratch the surface and kind of show you guys what this matrix looks like. I mean, there's crazy matrices I've seen out there, something like this, right? Correlation matrix, daily percentage change correlation over the last 6 months. And this goes over individual sectors within equities. So right now, we're looking at S&P 500. We got discretionary, staples, energy, financials, healthcare, industrial, materials. I mean, all the different sectors within the S&P 500. We got oil. We didn't even talk about oil. I mean, there's a lot of commodities, right? You can look at gold, the dollar index. We got long duration bonds, short duration bonds. We got real estate. I mean, there's just a lot of asset correlation that you can drive and really understand, how all of that works. So again, a very simple, I didn't even include the dollar index, but you can see the S&P 500 and the dollar have a very strong negative correlation, right? They've got negative 0.45. They really don't like each other. So when S&P 500 is up, chances are dollar index is down because of that severe negative correlation that we have. So again, we're going to build on this. I just wanted to, again, scratch the surface a little bit, and you'll notice that stocks are more positively correlated and bonds are more negatively correlated. Just in general, because that's how they tend to move in the market environment. So again, I hope you guys enjoyed this video, found it helpful. If you did, make sure that you drop a like. Just wanted to talk a little bit about asset correlation, and we're gonna build on this because I'm also gonna be moving a little bit more towards some of the more harder physical assets, and continue to diversify a little bit more because of all the uncertainty that there is in of course, the macro backdrop that we're dealing with. So hope you guys enjoyed this video, found it helpful. If you did, make sure that you drop a like. Let me know your thoughts down in the comment section below. As always, happy investing, and I'll see you all in the next video.